Unlocking the path to early retirement doesn't always require vast sums of money. Imagine starting with just $5 and turning it into a substantial fortune, allowing you to retire on your terms. Renowned investor Warren Buffett has a method that might surprise you. He generates a remarkable 71% of his dividend income from just 5 stocks. But how? You ask. Come along as we delve into Buffett's strategy, demystifying how he transforms modest investments into substantial wealth through dividends. But before we get right to it, make sure to subscribe to the channel and give this video a like. Also, make sure to pay close attention to the method, as it's guaranteed to be a game changer. Now, let's uncover the magic behind Buffett's $5 to early retirement method. Warren Buffett's snowball effect on dividend investing. Did you know that a whopping 57.7% of Buffett's colossal $375 billion portfolio is hanging out in just 2 cool places, Apple and Bank of America? Now that's putting a lot of eggs in a couple of baskets, but there's a method to Buffett's brilliance. Ever heard of the 5-to-1 rule? It's like a strategic dance between your spending habits and smart investing. For every $5 you splurge on, say, shopping at Walmart, you toss $1 back into Walmart stocks. So if you drop $15 at Walmart, you're planting a $3 investment seed in the company. The same goes for Costco. Spend $80 there and you're wisely throwing $16 into Costco shares. This way, you're creating a balanced investment strategy aligned with your spending patterns, all while enjoying the sweet compounding effect over time. Now let's delve into the true essence of dividend investing. It's more than just companies tossing regular payouts your way. It's a commitment, a promise to share the success journey. When a company makes a profit, it can either reinvest, save it for a rainy day, or shower shareholders with dividends. And guess what? Dividends are like real profits in your pocket, not to mention a solid source of income, especially in a diversified portfolio. But wait, there's more. Dividends aren't just about the cash flow. They're like a health report card for companies. The ones that consistently pay dividends are like the wise elders of the business world, financially sound and weathered through economic storms. They're the rock stars of stability. Now let's shift our gaze to the maestro himself, Buffett. His approach to dividend investing is like a secret sauce, rooted in a philosophy of valuing a company's worth, not just its price tag. He seeks out companies with a competitive edge, a killer brand, a unique product, or a dominant market position. Think Coca-Cola and Apple, not just industry leaders, but institutions that have withstood the sands of time. Buffett's not in it for quick wins. No siree. He's all about the long game, focusing on the growth potential of dividends over time. It's like planting seeds that grow into towering money trees over the years. The real magic happens when you reinvest those dividends. It's like a snowball effect. The more you reinvest, the bigger your investment, and the larger your future dividends. Buffett calls it the 8th wonder of the world, and who are we to argue with the investment Jedi himself? The compounding tale of a secretary's $7 million legacy. Let's dive into some real-life tales that showcase the remarkable power of patience and a long-term perspective in the world of dividend investing. Grace Groner's story, a true classic, takes us back to 1935. Grace, a secretary with a modest income, decided to invest in her future. She bought 3 shares of Abbott Laboratory stock for about $180. Now here's where the magic happens. Grace held on to those shares for her entire life, consistently reinvesting the dividends. Through stock splits and the compounding magic, her initial investment of $180 blossomed into an astounding $7 million by the time she passed away in 2010. Grace's journey is a testimonial to the impact of reinvesting dividends and the astonishing growth potential that a well-chosen stock can have over several decades. Now let's shift our gaze to Anne Schreiber, a retired IRS auditor who wrote her own success story. In the 1940s, Anne invested $55,000, and by the time of her death in 1995, that investment had transformed into a jaw-dropping $22 million fortune. How did she do it? By smartly investing in dividend-paying stocks and consistently reinvesting those dividends. Companies like PepsiCo and Bristol-Myers Squibb quietly and powerfully grew in her portfolio over the years. Anne's tale demonstrates how even a relatively small investment can evolve into a substantial fortune over time, illustrating the true might of compounding. Now, imagine an individual who starts investing $100 a month in a diversified portfolio of dividend-paying stocks at the age of 25. This investor diligently reinvests all dividends, sticking to the practice for 40 years, assuming an average annual return of 7%, including dividend reinvestment. By the time this individual turns 65, their portfolio would have blossomed into over $250,000. This hypothetical scenario underscores a crucial point. It's not about starting with a massive sum, but about consistency and reinvesting dividends. The power of compounding in dividend investing is a tried and true strategy for accumulating wealth over time. And the best part? It's accessible to anyone who adopts a patient and disciplined investment approach. So, the key takeaway is clear. When it comes to investing in dividends, think consistency, think reinvestment, and watch the magic of compounding unfold over the years. The $5 entry ticket to dividend success. Now that we've unraveled the wonders of compounding and peeked into real-life success stories, you might be itching to kickstart your journey into the world of dividend investing. Well, here's the good news. You don't need a mountain of cash to get started. In fact, you can dip your toes into the investing waters with as little as $5. Yes, you heard that right. In today's digital age, investing has become more accessible than ever. Platforms like Robinhood and Acorns have shaken up the investment landscape, making it a playground for individuals with both big and small pockets. Robinhood, for instance, lets you snag fractional shares of stocks, meaning you can invest in high-value stocks even if you're working with a modest amount. On the other hand, Acorns specializes in micro-investing. It rounds up your daily purchases to the nearest dollar and invests the spare change. It's like planting seeds without even realizing it. These platforms are user-friendly, making them perfect for beginners who might be dipping their toes into the investing pool for the first time. With just a few taps on your phone, you can be on your way to building your investment portfolio, even if your funds are limited. Now let's talk about the golden rule. Start early. Time is the investor's greatest ally, and the earlier you jump in, the more time your investments have to grow and compound. Even if you're only tossing in small amounts, starting early gives your money the runway it needs to take off. It's like having a head start in the race towards financial growth. Seeing beyond short-term market fluctuations. All right, as we delve into the final leg of our exploration into dividend investing, it's time to tackle the risks and considerations that come with it. Understanding these aspects is like having a compass in the stock market wilderness, guiding us towards success. First things first, let's recognize that investing in the stock market isn't a smooth ride. It's a roller coaster with its fair share of ups and downs. Market volatility is the name of the game. Stock prices can change daily, dancing to the tunes of economic shifts, political happenings, and the overall mood of the market. These price swings, especially in the short term, might make your investment journey a bit bumpy, possibly leading to losses. But fear not. Embracing a long-term mindset is like putting on a sturdy seatbelt for this roller coaster ride. Take a cue from the legendary Warren Buffett, who's all about the marathon, not the sprint. He famously quips, "Our favorite holding period is forever." This philosophy is particularly crucial in the world of dividend investing. Short-term market hiccups can be nerve-wracking, but adopting a long-term view allows you to weather the storms. It's like standing firm amidst the market commotion and reaping the benefits of gradual growth and the magic of compounding dividends. Remember, the stock market has a historical tendency to trend upwards over the long haul, even if it throws a few curveballs your way in the short term. So, as we navigate the twists and turns of the market, let's channel our inner Buffett and stay focused on the big picture. Instead of being swayed by the day-to-day market drama, let's keep our eyes on the long-term potential of our investments. By doing so, we align our strategy with the proven approach of successful investors. It's not about the sprint to the next big win, but rather the steady, enduring journey toward financial growth, Buffett's diversification magic. Now let's shine a spotlight on another crucial aspect of a savvy investment strategy: diversification. Think of diversification as the secret sauce that adds a layer of safety and balance to your investment mix. It's like not putting all your eggs in one basket, but rather spreading them across different baskets, sectors, industries, and even geographical locations. Buffett, the maestro of investing, exemplifies diversification in action. Sure, he's got a solid stake in sectors like financials and consumer goods, but take a closer look, and you'll find his portfolio is a colorful mosaic of holdings spanning various industries, from tech to healthcare. This strategic diversification isn't just for show, it's a smart move to dial down the risks tied to any single sector or company. Now, in the realm of dividend investing, diversification means having a mix of dividend-paying stocks from different industries and perhaps even different countries. This diversified approach acts like a financial shield, softening the blows that sector-specific downturns and market turbulence might throw your way. It's almost like having a backup plan. If one industry takes a hit, the others may step up to the plate. But wait, there's more to this diversification party. Consider adding other asset classes like bonds or real estate investment trusts to your investment mix. They bring a different flavor to the table, complementing your dividend-paying stocks and enhancing the overall balance of your portfolio. Remember, the key is not just having a diverse array of investments, but also adopting a long-term perspective. Picture it as building a robust fortress for your finances, one that stands resilient against short-term market storms. By embracing diversification and a long-term outlook, you're not just lowering risks, you're setting the stage for a secure and potentially rewarding investment journey. So buckle up and let diversification be your guide in this financial adventure. Buffett's triumph in the realm of dividend investing isn't merely about pinpointing the perfect stocks, it's a tale of patience, astute reinvestment, and savvy strategies. The beauty of it all is that you don't need a massive starting sum. Even kicking off with as little as $5 can set you on a path toward financial independence. So start with modest steps, dream big, and witness the magic as your investments gradually blossom. What are your plans for retirement? Share it with us in the comments below.